If you want to build generational wealth through real estate investing, I'm going to show you how to do it step by step here today. So popping in the whiteboard here, we're going to have property number one. I'm going to draw a little funny house there for you. Boom, there's our number property number one. We're going to have one property and we're going to fill it with A+ tenants that are going to pay you rent every month. This is how the process starts. And there's four main things that you get as a real estate investor that's going to build up what's known as equity and increase your net worth and be able to create that generational wealth for you over time. But with that first property right here, the first thing that's going to happen is every month, number one, you're going to get some kind of cash from your renters, right? You're going to get some kind of cash flow. And if we just put that in here right there, we've got cash flow. We put that in there right there. We've got cash flow every month. Okay. And hopefully when there's more cash coming into the property or there's more rent coming in minus the expenses, you get leftover cash flow. And that is kind of the extra money you have left over every month. And hopefully that's a positive thing. Let's say for this property, you have a rent coming in of $1,200 and you have expenses of $1,000. So your cash flow would equal $200 per month. And so if you actually take that number out there and take this cash flow and extend it over the period of a full year, you're going to end up with $2,400 in your pocket. Okay. And it doesn't sound like a lot of money right now, but there's other pieces we have to add to this and then actually apply some kind of scales of time to really see how this adds up. So we're going to start with that. And we're going to go from there. So we've got our cash flow on number two. What happens when you have rental properties is that the actual mortgage gets paid down each month by your tenants or by the people in that property renting it from you. What that means is that when you buy the house here, your mortgage on this graph might start somewhere around here. And as they pay it down over time, the mortgage just kind of slowly starts there, slowly kind of gets down to here. And here's, boom, the time where it actually gets paid off. And that's when you have $0 left on your mortgage, which is a great spot to be. That's what you want to have done. So for our property number one here, let's say we have a mortgage here of $300,000. And generally, you can expect every single year for that to be paid down by about 2%. So if we talk about just doing some simple math here, times 0.02 is 2%. And that's going to equal $6,000. But the good news is that this $6,000 is only in year one, right? That's going to be year one. Like I said before, on this same chart, when you have this kind of price right here and the mortgage gets paid down over time, it gets paid down quicker and quicker and quicker and quicker and quicker. So you're going to have a bigger pay down every year. So that number is actually going to increase over time as we move out through time over the years. So now with these two items by themselves, we have $2,400 for cash flow. We've got $6,000 for mortgage pay down. That's all equity being built in your pocket. So we're almost up to almost $9,000 with just items number one and two. Let's go on to door number three. And door number three is all about tax savings. So when you have a rental property, you can actually write off different expenses that you might have. If there's any kind of maintenance or repairs, if something leaks, if you have to get somebody to service kind of for cleaning, if you have kind of insurance costs, anything that's kind of an expense for the property, you get to write it off, WO, write off at tax time. And it depends on where you live and kind of the jurisdiction you're in and your tax code and all that stuff, but you end up saving a ton of cash just because of the tax savings right here. And that's number three, which is very simple. I usually hand my taxes off to an accountant because it's easier for them to find the deficiencies, to find the savings, than for me to do it myself as a non-trained person. So let's be really safe here and just say we have tax savings of $1,000 in year one. Combine that with the $6,000 for mortgage paydown and $2,400 in cash flow for the whole year. You get a grand total of $9,600 in year one with those three items. Boom, boom, boom. That's not bad. If you extrapolate that over 10 years, right, it becomes 96 grand. And then that's some good money. But we want to make more than this. We want to make sure that we're making more money because 10 years is a long time to wait for 96 grand. Like we could be making more and doing more. And that's why we always want to invest and have these things. Number one, there's a fourth door we have to go through to kind of amplify some of our returns that we can't always count on, but it's nice when it does happen. And that last door number four here is what's called appreciation. That's when your house price goes up in value over time. Now, it's not a guarantee that it's going to do that, but generally you can kind of assume in certain times, economic conditions, that 3% is a very conservative estimate, depending on the market that you're in. If it goes up by 3% per year, a home that's valued at $100,000 today will be at $103,000 the next year, then 106 point whatever after that, and just kind of slowly keeps up. It looks like this on a chart. Your home value starts down here, let's say, and it starts to slowly over time, it starts to creep up as it goes up. And because of inflation, because of different things, your home has value. It goes up over time and holds its value. That's appreciation. Again, you can't count on that. You want to definitely count on cash flow number one, having mortgage paid on number two. Those are givens. You hopefully get some tax savings as well. Then appreciation is like the cherry on top. You don't always get it, but when it does happen, it speeds up the process greatly. So in our example, if our house is worth 400,000 and we have a mortgage of 300,000, we have a little bit of room for equity to build. Times 0.3, we're going to end up getting $12,000 per year. So again, first year is 12,000, then it goes up, then it goes a little higher, then it goes up, then it goes a little higher, and that's going to just keep creeping up and creeping up every single year. So if you add up all these things, 2, 3, 4, you get a grand total of boom, boom, 2, 1, 4, 0, 0 in year number 1. Not too shabby, right? And like I said, it's going to extrapolate over time. And this number is going to grow every single year, and you're going to keep building equity in your property. What do I mean by equity? I mean this. On our chart of time here with a rental property, your price of the actual property is going to start right here. The value of the property is going to start here, and your mortgage is going to be here in red starting right here. And as the mortgage gets paid down over time, until it gets down to 0 somewhere down here in the future, the price of your house hopefully is going to accelerate and increase and increase and increase and increase. And that divide there, that room in between here, that is your equity building. All this equity right here. And there's this whole area right here is now equity. Once you have the property paid off and it keeps growing, you have an asset that's paid off, funding your lifestyle for you. And that's just one rental property increasing in value year over year with these 4 kind of major things. Again, the first 3 are almost guaranteed. Number 4 is an added cherry on top. So you want to always invest for the first 4, and especially cash flow. You want to have investments with cash flow. That'll save you during hard economic times. But the other 3 are also very good tools to kind of increase your wealth in real estate. Now, it gets really exciting when you actually combine all this for one property and we take it and apply it to property number 2. So I just draw another house right here. We'll say this is number 2, and hopefully this is a little bit better than the last one, a little bit bigger, a little nicer, right? You have another property. We're going from 1 to 2 properties now. That amount, that 21,4, right? If you have 2 properties, you times that by 2. Now we're talking about 42,800, right? In equity. And like that's like a full year's salary for some people. That's a good amount of change every single year that you're going to be adding to. And again, this number is 42,800. It's going to grow year over year because the appreciation gets a little bit bigger. The mortgage gets paid on a little bit quicker. You hopefully get a little more cash flow as rents increase. And it extrapolates from there. If we go from 1 to 2 to 3 to 4 to 5 to 6 to 7 to 8 to 9 to 10, right? If we time this number by 10, this initial 21,4 by 10, what do we get? We'll just fact check this and say we get to property number 10, which is like a big box right here. We got 10 properties in our portfolio. Break it up like that, okay? And you're adding this number here, 2, 1, 4, 0, 0, 0. That is a lot of zeros. That is a lot of cash being added to your net worth in equity every single year. You can quickly see that over time, when you have a bunch of properties like that, and if you zoom out, you're going to be able to get a large chunk of change in equity every single year. Again, that number is going to also grow over time as things get paid down, as your asset keeps depreciating up, right? This gets paid down. This gets paid down. This one goes up. That equity starts to build in there, and away you go. But how do you actually get these properties? It's through a process called refinancing. So this process of accessing equity in your properties is known as refinancing. And all that is taking your property that you have here, number 1 again, we'll stay there. And once you have a certain value of your house, let's say that the house is now valued at 500K. And your mortgage that's left over is at 300K. Say the mortgage hasn't moved, but you paid, the house has gone up in value. You can normally access up to 80% of the value of your home, of this value right here. Okay, 80% of that value, and that can be taken out in the form of an equity or kind of a line of credit. So 80% times 500,000 is 400K. So we would go 400 minus 300, which is our existing mortgage, right? And that would equal $100,000 of equity that we could take out to then what we want to do with that equity. Well, it's obvious, right? What we're going to do with the 100K, like put in the comments, what do you think is going to happen? It's a pretty no-brainer what we're going to do. If we're going to do this and keep growing our portfolio, what that 100K is going to go towards is we're going to turn around and use that 100K big smackers to purchase part of property number 2. We're going to get out here and use that as a down payment for number 2. And when we hit 80% on property number 2, we get that kind of leeway again over time. We're going to take that and we're going to take it out and we're going to go 100K again or whatever the number is going to be, hopefully more. And we're going to go over here and we're going to go and get property number 3. Right? And then number 4 and 5 and 6 and whatever it may be. And we're going to keep doing that and keep increasing our kind of portfolio over time using borrowed money or equity in our properties to do so. Now, it gets really exciting when you kind of extrapolate it out over time, but this is how you can create long-term growth and financial freedom, generational wealth through real estate by using the 4 principles we talked about. We're talking cash flow, we're talking mortgage pay down, we're talking tax saving, we're talking depreciation. And once you harness the power of these things, you then use the equity and the refinancing option to go ahead and get property number 2, 3, 4, 5, and build your portfolio. So you encompass all these things and you build generational wealth for yourself through real estate. Now, if you're doing this, you're probably gonna have some questions like, how do I buy properties with a low down payment? Or if I don't have a lot of money, how do I get started? And one of the biggest questions I hear all the time is, how do you avoid losing money in a rental property? So if you want to actually know how to avoid losing money, and you don't want to lose this stuff right here, right? You want to avoid losing money in your rental property, make sure you subscribe to this channel, like this video, and check out this video right here. I'm going to show you the most important things in a rental property to help you avoid losing money in your investment.